Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Aclaris Therapeutics Inc. quarterly report. Aclaris Therapeutics Inc. is a clinical-stage biopharmaceutical company focused on developing novel molecule product candidates for immunoinflammatory diseases. The company's pipeline includes several promising treatments that target various conditions. One of the key products in Aclaris' pipeline is bosakitug, at -45, an antithymic stromal lymphopoietin monoclonal antibody being tested to treat atopic dermatitis, asthma, chronic rhinosinusitis with nasal polyps, and chronic obstructive pulmonary disease. Another product at -2138 is a dual inhibitor of ITK and JAK3 in Phase 2A trial for the treatment of T-cell-mediated autoimmune diseases. Aclaris is also developing AD-52, a humanized anti-TSLP and anti-IL-4R bispecific antibody in Phase 1 billion to treat various atopic, immunologic, and respiratory diseases. Additionally, the company has AD-9494, an oral dual inhibitor of ITK and resting lymphocyte kinase, TXK, as well as other covalent JAK-sparing ITK inhibitors for modulating T-cell biology across various diseases. Furthermore, Aclaris is working on lepsacitinib, a soft JAK1/3 inhibitor for the treatment of atopic dermatitis and other dermatologic conditions. These innovative treatments have the potential to provide relief for patients suffering from immunoinflammatory diseases. Aclaris Therapeutics, Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. Aclaris Therapeutics, Inc. trades at a higher price-to-book ratio of 4.81 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 36% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This also raised the question if that management is diluting shareholders to sustain the business. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. If the business does not improve its revenue and generate positive cash flow, the company will continue to struggle to cover its cost and interest expenses. This combination makes the investment case highly unfavorable unless earning issue is addressed. On top of the cash-burning business, shareholders are consistently diluted. I may be wrong, but I would suggest to stay away from such investment for now. The primary drivers of revenue growth or decline can be identified through a review of key agreements and milestones. On the growth side, contract research has been a significant contributor, with a 21% increase in revenue attributed to this area. Licensing agreements have also played a crucial role, with a 45% increase in licensing revenue reported. In addition to these areas, upfront cash consideration from exclusive license agreements, milestone payments, and royalties have all contributed to revenue growth. The company has secured several significant licensing agreements, including one with Sun Pharmaceutical Industries, Inc., which is expected to generate $0.2 million in revenue growth. Another agreement with Aclaris Therapeutics, Inc., offers potential for significant revenue growth through tiered royalties. The Lilly license agreement and the Confluence agreement also offer substantial revenue opportunities, with the former generating $1.3 million in 2026 and the latter providing up to $75 million in contingent consideration based on regulatory and commercial milestones. Overall, these agreements and milestones have driven significant revenue growth for the company. The company's financial performance indicates a decline in its ability to generate positive operating cash flow. The data shows that the net cash used in operating activities has increased from $13,057,000 in 2025 to $18,149,000 in 2026. This significant increase suggests that the company is struggling to manage its expenses and generate sufficient revenue to cover its operational costs, resulting in a negative operating cash flow. Management is expressing a cautious outlook for the company's short-term prospects. They anticipate incurring significant expenses and operating losses, which will require substantial additional funding to support operations. If unable to raise capital, they may have to delay or discontinue development of certain products. In terms of product development, management is optimistic about the potential of bosakitug, with plans to announce top-line data in Q4 2026. They are also exploring partnerships for global development and initiating a Phase 2 billion trial of AD-2138 in lichen planus subtypes. Looking ahead, management intends to pursue product candidates based on development requirements, in-license or acquire additional products, and prepare patent applications. They will also identify and consummate transactions with third-party partners for further development and commercialization. In terms of funding, management expects to finance operations through a combination of equity sales, non-dilutive financing, partnerships, and other capital sources. However, they acknowledge that additional financial resources may be needed if clinical trials take longer than expected. The company's financial activities have been notable in recent years. One key aspect is its approach to shareholder returns. In terms of dividends, the company has chosen not to pay them out to shareholders. This decision suggests that management may be prioritizing other uses for available funds. On the other hand, the company has engaged in share buybacks. Specifically, it purchased 18.4 million common shares through the sale of stock in March 2026. This move is aimed at reducing the number of outstanding shares and potentially boosting earnings per share for remaining shareholders. That concludes the financial summary for Aclaris Therapeutics Inc. Feel free to comment below, and I will be happy to answer them when possible.